Look, the playbook is pretty clear, right? You get a knee-jerk reaction, and now this is about our third or fourth really bad COVID scare in the last 2 years, what to do moving forward. I'll say this, if the Omicron turns out to be something of concern, you're going to deepen the fundamentals that are already in place, which is higher inflation in the short term, followed by a slowing later on in the year. And so our playbook looks pretty much the same, which is position your portfolio, a little bit of headwinds from the inflationary front, the opportunity for a policy mistake coming from the Fed, because this is a very difficult period. But then ultimately on the other side, you're moving over, you're going to roll over some ISMs, you're going to roll over some PMIs in the middle of the year, and that's what you really have to look for. We like tech here. Dance with the one that brought you. This is the sector that can earn through anything, and then we think that's the playbook that you go through in the next few weeks. Also look to reopening because we'll get there.
Sylvia, I've seen both sides posited on what it means for the Fed, and Alicia just referenced it, but if there's now more supply chain issues around the world, theoretically, because of this, inflation stays bad and the Fed doesn't get a respite from tapering, but it actually increases tapering, or is that flawed thinking?
So I think
in my mind, in my mind, I think that the Fed now has an excuse or reason to sort of stay on course with the tapering and go slow and steady, and perhaps even push off rate hikes. Yes, inflation is an issue. I do think the supply chain issues will start to ease up in the second half of next year. Perhaps they slow down a little bit now because of the travel restrictions. But if anything, it goes back to the original reason why the Fed took their time on this, and that's jobs and the economy getting back on track. So if we have slower GDP because people aren't going out there and consuming services and traveling and doing things like that, if this impacts the jobs numbers and people sort of have to stay home because of, the demand, being restricted by COVID and the lockdowns and potential changes in behavior, then I think the Fed has a reason to sort of slow down. But, like Alicia said, I do think that this is a bit of a knee-jerk reaction. And the news that we're getting from the drug makers is there's a light at the end of the tunnel, perhaps 100 days to adjust the vaccine, and, potentially positive news on that the current vaccines that we have in the boosters do work. So I just expect today to actually be another buying opportunity because of all that.
Right. Well, that's one of the promises of the new technology, the new messenger RNA type vaccine. It can be adjusted quickly. I guess it means, I'm ready for my 3-month vaccine. Maybe that's what it means at some point. I don't know whether that's a good thing from here on out to go quarterly, but who knows what's going to happen. Let me, Alicia, get back to the market and just talk about dip buying. Until we know that's over, that's the right move. And I think there's a lot of reasons for it, because we were in a great reopening scenario. The economy looked really great after what we have been through for the past couple of years. We're going to reopen. Things are eventually going to get back to normal. We thought anyway, and we still had these really low interest rates. So how could you not buy stocks? Low interest rates in a reopening economy. Is that still what we're seeing? Or is there an actual threat that we deserve these low interest rates? Because it's not going to be. We're going to have a much slower global growth outlook than we thought previously.
Well, we deserve the low interest rates because globally the rest of the world is not recovering in the way that the U.S. is. And I think Europe is an indication of that. I mean, Europe very well could have a triple dip here in terms of its recovery if we see the reaction to COVID kind of deepen from what we heard last week. So if their bond market stays deeply negative on yield, it's going to affect our bond market as well. So rates stay low, U.S. grows out of it. Maybe there's a delay of a month or two, but ultimately we are much better positioned here in the U.S. from a company point of view and reopening. We would still look ahead to the deeper reopening in the services in the spring and the summer. That is still our playbook here, even if it gets delayed. We do think that in the short term, inflation will be higher because of the supply chain issues not quite getting worked out just yet, if there is a reluctance to engage in services in the short term. But you have to invest for the long term. And so this was a gift wrapped in a bow.
Shepard Smith here. Thanks for watching CNBC on YouTube.